Hello, everyone, and welcome to our webinar today on recent Treasury and IRS guidance related to Section 603 of Secure 2.0. That's the Roth catch-up contribution provision that we've been talking about so much this year and spent so much time on. For those of you I haven't met, my name is Matt Petersen. I'm NAGDCA's Executive Director. Before we begin, I'll let you know our standard webinar disclaimers. We are recording this presentation, and it will be emailed to everybody who registered later. We don't have any slides today. We're just going to be talking. So you'll get a recording of the presentation, but there aren't any slides for you to look at. You'll be muted for the duration of the webinar, but please submit any questions you have throughout the presentation in the Q&A box at the menu at the bottom. We'll get to as many of those as we can. We already have some from the registration process. So thank you to all of you for sending those in. And thank you to all of you on the West Coast for joining a little early today. Your questions are only going to be visible to the speakers, so send those anytime. And joining me today for the webinar to decode the guidance that we received late last week, about 4 o'clock Eastern on a Friday, which is always nice. Two of our favorites, Brigham Winters and David Levine, both principals at Groom Law. Welcome to both of you. And let's dive straight into it, guys. I thought it'd be best just to walk through some of the different parts of the guidance and then just parse out exactly what everyone needs to know from what we saw there. So sections 1 and 2, summary and background, and then we get into section 3, which starts a little more of the guidance. David, you want to talk a little bit about, there's a lot of cross references in here, but there's some important elements. You want to talk a little bit about what section 3 has for us?
Sure. There's a couple different things that really come up here, Matt, in section 3. First of all, there's a lot of press after Secure 2.0 about whether even catch-up contributions will be around after 2023. And the IRS, in a little sort of like one sentence, basically effectively deals with that and says, yes, despite the changes to the statute, catch-up contributions will still be there. That was a NAGDCA priority, one of our first things we talked to the IRS about. And we said, look, you've done this for all of you who do governmental plans on this call, of course. You know that this came up with some of the things in your defined benefit plan on healthcare expenses long ago. And they acknowledged that in this guidance and quickly dispensed with that. That's one big item here at this point. Then in section 3, that we get a whole discussion here about Roth catch-up contributions and how they're going to work, and both under 401k plans and as well as 457 plans and 403b plans, but it provides a pretty basic overview here. Separately, what we also get in here is just the reminder that you basically do an aggregation situation if someone participates in more than one plan, but it's not necessarily on the plan administrator or the plan sponsor to sort that when you have different plans that are not sort of in your orbit. If an employee works for 2 different organizations, you can't be the one to do this, and testing has always been set up that way. So that's kind of a key thing. The IRS sort of, when we begin with section 3, really just walks us through the basics that I know many of you, especially those of you who've been through our webinars before, have heard all about in Secure 2.0. I don't know, Brigham, Matt, anything you think I missed on that one?
No, I mean, I think, as you noted, a huge takeaway that shouldn't be lost. And I think Matt and NAGDCA and the organization should be credited with being kind of the voice of reason when a lot, other parts of retirement world were kind of in a tizzy as a result of drafting glitch in the 402G section and worry about catch-ups going away for all time. I think that shouldn't be lost, lost in the shuffle as we go through this guidance. And as we'll go through it, I think all in all, it's very, very positive developments in this notice, especially as compared to where we thought things may be headed.
Right. So, section 3, we kind of assumed, I think we felt it was pretty clear that catch-up contributions didn't need to go away. Section 4 was a little more of a surprise. I think, maybe all the way up until we received it, it was something that we didn't expect. So, Brigham, you want to talk a little bit about section 4? There's an administrative transition period, which I think is a really helpful way to frame this. What is this telling us?
Sure. Yeah, we just a bit of background. I mean, we definitely had our ears kind of plugged in, talking to regulators and the Hill as to kind of where things might be headed. We kind of worked on separate tracks, both talking to the Hill and congressional staff about possible either technical corrections or probably more likely clarifying legislation, ideally as soon as possible this year, at worst case, kind of an end of the year bill that would effectively delay the effective date. This was one of those situations where I think things were moving fast at the end, where they didn't provide, they provided a very fast effective date for everyone, particularly in light of complicating the rules a bit in the final negotiations, where they added this 145,000 kind of cutoff feature and Roth feature, but also not providing a special rule for governmental plans, as would typically be the case, or for collectively bargained plans. So in addition to talking to the Hill about legislation, we also orally and in comments provided recommendations on using IRS and Treasury authority to provide a transition period, effectively non-enforcement and effectively delaying the effective date in terms of for operational purposes. We had heard that things might be headed in a different direction, where there might have to be later corrections on top of the whatever relief was being provided. Fortunately, that's not where they landed. They basically, without expressly delaying the effective date, they did provide a 2-year transition period, to provide for an orderly transition to these new rules that basically applies until through 2025. So for 2024 and 2025, there is very broad relief, and it appears very clearly that there doesn't have to be any kind of corrections later. So what this means is you can still take cash up contributions on a pre-tax basis, even for those affected participants over the $145,000 wage base. It also means that if a plan doesn't currently offer a Roth contribution option, it will still be treated as compliant and won't need to add the Roth feature in order to allow catch-ups. David, Matt, anything else you want to add?
Yeah, anything you want to add there, David?
The only comment I'll make on this is it's actually very interesting. Whenever you're advocating, you always hope for the sky, the moon, and the earth, but you're willing to accept a small little hut in the woods. But here, the 2-year delay was one of the things we actually floated early on, like as NAGDA was floated to the IRS as one of the early letters, and then it was a great collaboration across the industry. Different trade groups, different employers, and everything, not just governmentals, came together. But it's interesting that we actually all basically wound up pretty close to where we wanted to be, where we said, give us an extra 2 years. And it's really good, and it's a sign of how the consensus in the industry, not just governmental plans, but private plans, service providers like service provider members of NAGDA, all sort of sung from the same hymnal here. And I think it really sort of shows, because the IRS generally is pretty conservative on these things. And it shows they really listened, and I think we're all very appreciative of the IRS trying to work with us on this at this point.
And they, and just not to belabor the point, but I think the added complexity was, really the reason why this made it into the law it was the biggest revenue raiser, kind of revenue offset to pay for other provisions. And I think there was concern on the Hill and probably at the agencies about an explicit effective date, that took into account the revenue increases coming from the Roth feature, just kind of undoing that. So I think that was part of the challenge to kind of get them here. So I think the NAGDA and its members and kind of the community should really be congratulated for keeping up the drumbeat, and Treasury and IRS should be congratulated for coming out in a good place.
Yeah, it's not often you get to say thanks to the IRS for doing a good job, but that this is certainly one of those cases. I think they really did listen to us and worked very well with us throughout the process. So we are very thankful to them. A couple things that I want to highlight on this, and just to make it crystal clear. So we did have some questions in the registration process to say, hey, do you think this means eventually maybe this goes away? It seems, the congressional staff is very much set on the fact that this is a revenue raiser. It's important. They need it in there. So while there is a 2-year period here where, where you can get your programs in place, it's coming. So you should very much assume that. Is that 100% fair?
Yes, absolutely. I really do not. I do not see this going away. I think we have the 2 years. I think, we'll talk more about additional comments we can provide, but I really do not see this going away. I do, however, see, a line being drawn where people really don't want any more quote unquote Rothification. I think NAGDA and others in the industry fought that off in the tax reform, Tax Cuts and Jobs Act in 2017. This was a little bit of foot across the line, and I think people probably are going to draw the line and say no more. Would be my gut, but I think this one's here to stay.
Yeah, a really important point there. So we do have it for those of you who have checked out our NAGDA legislative priorities. Rothification is something that we've been against for years. This is it is a small group. That was maybe why it was a little more politically palatable to push this one through, but it's something that we're very much watching to make sure that it doesn't become a broader trend where it becomes catch-ups and then potentially regular contributions down the road. So again, it doesn't look like anything's going to change long term, and nothing really changed with the law, right? This guidance doesn't change anything. It just says, hey, you have this transition period while you're getting things in order. It just gives you a little more time, correct?
Right, that's
Okay.
correct. And I think there's one big takeaway on this. Since we had our last webinar, and I know there's been different discussions at NAGDA meetings and other types of items, there a lot of the details of this, how you deal with payroll systems, especially for governmental entities, for those you have your own payrolls, and for data feeds and who does reporting. There's a lot that's unresolved at this point. And if you ask, for instance, a bunch of the service provider members of NAGDA, how do you operate? Each of them probably had slightly different answers as to how they were planning to do this. We're in a moment right now where you have time to keep working on your systems, but I think we all need to recognize it's going to take another 6 months, 9 months, some IRS additional guidance to say, well, this is how we think it should work. And this is where NAGDA is going to engage, because just because we have more time, you should keep moving, but also recognize there's a lot of things that need to be worked out in the meantime. So it's important to mention that. I think you're going to see a lot of people, and we've already seen it with a bunch of our governmental clients, say, we're going to pause for now. Let's figure out some of the details so we don't put something in place the IRS tells us it was different than what they wanted in the end.
Great point. Great point. And so our primary concern was addressed, which was just the time, and that was something we emphasized very much, that we weren't pushing back against the law itself. We were just pushing against the timeline. So we did get some relief on that. But as you mentioned, David, a lot of work remains on this. There are a lot of large issues, and some of those were brought up in Section 5 of the guidance that was put out. So let's address a couple of those specifically. Now, I do want to be clear, Section 5 isn't guidance, right? Section 5 is just things that they are considering for guidance, but they kind of tip their hand a little bit on some interesting stuff. So let's walk through a few of those. The first one was related to FICA wages. And this one I actually wrote David when it came out, and I said, am I reading this right? So can you, either one of you, maybe David, walk us through a little bit, what does this section say? And what are the implications? Because it does specifically call out state and local government plans that don't have a FICA wage.
Absolutely. This provision was a surprise provision at this point. And this provision has relevance for, in the non-governmental space, some items for like partners and self-employed individuals. We're not going to worry about that. For government entities, the idea is many of you might be in jurisdictions where some or all of your employees are not subject to Social Security, FICA taxes, those types of items, because you have a Social Security replacement plan or something like that. Your plan may effectively replace Social Security, so therefore your employees aren't covered by the world of Social Security. And I'm simplifying here. The IRS, in a wonderful, positive thing, said, well, we're thinking about this at this point. If you didn't have any wages that are subject to FICA tax, therefore you have no FICA compensation. So maybe you don't need to do catch up for any of these people. We know that there's a limited number of governmental entities in different states that are not, and we can get into Section 218 agreements, all this wonky stuff, but put it into English. For those of you where your plan is like a replacement for Social Security, and you have individuals who therefore don't pay FICA taxes, they may have zero FICA wages. So even if they earn $200,000, the IRS is seriously considering saying here, we're not going to actually make those people do Roth catch-ups. And that is a huge, huge change. And they're saying they expect to include this at this point. That's really big. So for those of you who don't have Roth, like to really nail it to its core, for those of you who don't have Roth or don't feel comfortable implementing Roth catch-ups only for people over the 145, and if you're covered population or people who don't have FICA wages because you're not subject to FICA, you may just have a pass here, and you may never have to worry about this even after 2025, not 2005. So that's something to think about. Hopefully that was a simple enough explanation from a lawyer who's trying to fit a lot of big words into a sentence.
No, I think this one I think that was great. And it's a really important one. So, some plans come to mind like Ohio Deferred Comp, who is doing its own administration and its population doesn't participate in Social Security. Like you said, you may have a pass here. Again, this isn't guidance yet, but this is guidance they're considering. And it appears that they're considering if you don't have a FICA wage, you wouldn't have to convert your catch-up contributions to Roth, which would be a huge advantage for those plans. Now, I think a kind of a follow-up question, and we got this one from a member. It's one that from Jim Potvin. It's also one that I was thinking about is, as part of our process here, we had asked the IRS to consider wages as whatever the government defines. Could this have some implications here, or is that still something that's in play where we could say, government entities might define wages all kinds of different ways? Is that still something that we can push for and that the IRS could find, while still saying that those with FICA, who don't have FICA wages don't have to participate in this this part of the secure?
I think it is related, but not exactly the same, because I think this is a macro issue for many governmental entities, and admittedly, it even goes way beyond governments. A lot of plans don't use FICA wages, especially for defining what compensation is. These are whole new data feeds. The IRS has in the past, for instance, for those of you familiar, like with 415 compensation, which ties into 457 plans and other things, 415 compensation, the IRS has many different definitions you can use. And I think we can still advocate. Sometimes people will say, oh, we guarantee this. I think we can make the ask. Given how flexible they were here, there's a possibility of that, but I wouldn't bank on them going there. But we definitely can keep pursuing that ask to have flexibility. Also, we joke that Secure 2.0 is done. There's always Secure 3.0. So there's always clarifications and other things that I know with the legislative committee that we're going to go back and tackle and discuss about what are potential priorities there. Does it mean we'll get it automatically? No. But are these things that could either be done on a regulatory or legislative basis? Yes. And it's something I think that will probably be on our list as we go forward if the committee thinks that's a good priority.
Right. Brigham, anything you want to add there?
No, totally agree. I do think that's something we should. We've commented on before. I think it is still open for comments or future legislative efforts. I think I don't think this totally addresses it. It may make it a little bit more uphill, but I think we should continue to plow ahead with that and really come up with rules of the road, rules of administration that really work for folks.
Yeah. And much work to be done on wages generally, right? And we had some questions from some members who said, what if our collective bargaining agreements carry into the next year, and then wages are retroactive and it changes, pushes somebody over the line? We don't have answers for a lot of that stuff yet. So much more to come from us in the comment period. If you read the guidance, they still have a comment period open through towards the end of October. We will be sending some commentary and some questions in for further guidance. So more to come there. Okay, so let's move on from the wages a little bit into part 2 of section 5. This was a question that we got from quite a few of our members. It deals with, can an administrator, if somebody makes an election and a pre-tax and they're over the bar, they're over that $145,000 line, can the administrator just unilaterally turn that into a Roth contribution? It appears that they're saying that's the case. Is that what you're reading here, Brigham?
That's right. I mean, I think there was concern because under current rules, basically you need to have you have to have a Roth designation from the participant in order to at the time of deferral election to treat it as a Roth contribution. There were worries like, could you provide for like a spillover election once somebody hit the need for a catch up and was subject to this rule? Could you then kind of just the plan designate on its own that those spillover amounts would be treated as Roth? And there had been concern that under the current rules maybe you couldn't do it. Here they confirmed that you can have a spillover designation like that, and that could be carried over from year to year. David, anything to add to that?
I think you hit it. This is great. There's been so much concern about how you actually operate and implement when people haven't actually formally elected Roth, and this really provides a lot of clarity. There are other nuances that are coming up that we can get into, but I think that's a key thing. One thing for everybody to keep in mind, though, there's going to be an education discussion here to be had, regardless of this relief, which is fantastic. But there's going to be an education item because inevitably, especially as governmental plans, you have large bases of employees. What's going to happen is there's going to be someone who suddenly goes to Roth in 2026 and they don't even see it coming, even though they've been told, and their paycheck will dramatically drop because of the Roth taxation hit, and they will call up saying, "You never told me." So there is an educational and a disclosure process here. It doesn't mean that anybody's actually legally wrong, but there's a process that's already been in discussion that I think will continue, and there'll be a lot of planning on education as we go into 2026.
Yeah, and to be clear, we kind of had a follow-up question on this one. So what this appears to say is that you would be able to just administratively, if somebody's over that line and they elected to make catch-up contributions, you could just make those Roth on your own. You wouldn't need them to come back in and say, no, yes, I sign off that this is going to be a Roth contribution, which would help a lot, because we know that would be a difficult thing to get done, to have somebody actually do it twice, right?
It would, and also for governmental plans, there are some unique little twists about this just to keep in mind, just because different states have different processes for how people make elections and different rules about them. This provides sort of a nice federal overlay on this, which is very helpful.
Yeah, and like you said, we did have some questions in the registration about, my program, just if you contribute more than the maximum, that's a catch-up contribution. Can I make that Roth? This appears to say that you can. So again, not guidance yet, but guidance that's under consideration, and something that we'll be definitely saying is a good thing and hoping that they stick with. Then the last one here, so this one applies to multi-employer plans, which of course is relevant to several of our states, and it talks about aggregating the salaries for a multi-employer plan. I thought this one was really interesting. There was a little bit of ambiguity here to me, because it talked about, even if somebody had more than 145,000 from one of the employers under the plan, that might not necessarily push them over the $145,000 threshold if it's not the primary employer. So you want to talk about this one a little bit? I was really surprised reading through this, and
Sure.
I think we probably
Well,
need a little clarification on it.
this one is interesting, and we all know that governmental plans are unique. You are, especially where you have multiple employer plans for governmental entities. And there's this long discussion, and I don't think the IRS is trying to wade into it with what they've put out here. There's this long discussion about, is a governmental plan of an employer that has 25 towns in it one employer or 25? That's never been resolved. And I think the IRS has been very flexible and reasonable there. And I don't think they're trying to retread that world. But a real concern that's come up is, for some of the folks on this call, your system may have hundreds, thousand employers, and it's impossible to align and handle all the payroll back and forth, especially if it's not a unified payroll, to say that because you had compensation with employer A and employer 272, that we're going to put it all as Roth catch up because we added up the numbers. Here, the IRS has been incredibly flexible and basically says you look at the employer for which the contribution is being made, to which it's attributable, and look at the comp for the prior year. So take, for example, my example, I'll change it to employer one and employer 242. Employer one, if I only earned $80,000 with employer one in the prior year that was FICA wages, and I then the next year I'm contributing with employer one, it doesn't have to be Roth in 2026. On the other hand, even if I had 85,000 with employer one and then I had another 200,000 with employer 242, and the next year I'm contributing with employer one where I only had 85,000. Again, we don't need to do Roth with respect to contribution through employer one. You basically look employer by employer and to see where the money, what there was the prior year in compensation and where the money came from. And you just put it in its own little bucket. And that is a huge, huge efficiency savings. And it's just so practical. It's really a great outcome from the IRS. So I just think it's wonderful. It's where you use wonderful in the world of tax, but it's wonderful.
Reagan, anything you want to add?
Yeah, I agree. I think it was that one's a bit of a positive surprise. I mean, frankly, I think it's a really good result. I mean, folks are still going to have administrative challenges linking up payroll with retirement plan record keeping systems, but this takes care of one humongous hurdle or set of hurdles, frankly, that it looks like we're not going to have to deal with. I mean, there's still some open questions, particularly in kind of a control group situation, that I think we'll still want some guidance on. Typically under the retirement plan rules, if you meet any of the pretty complicated control group tests, you're treated as one employer. Hopefully this tips kind of against that, and you're still looking participating employer by participating employer in that little silo as a bucket, as David said. But that is one kind of open issue that I think folks will probably comment on.
Yeah, and I think that'll be very, very helpful. Again, it was surprising to us. It wasn't what we had heard generally in our conversations. One of the parts that wasn't addressed, and I don't know that this really, maybe it tips the way that they're thinking about it a little bit, but some of the multi-employers had asked, hey, if one of our employers doesn't doesn't implement Roth, doesn't have Roth, does that have implications for the other employers? Would the whole plan have to turn off catch-up contributions or anything like that? It seems like the IRS is kind of looking here at each employer separately, which is a good sign, but obviously they didn't address that issue particularly. But any thoughts on that?
I'll make one comment. I think you're leading us to their request for specific comments.
Yeah.
Because this takes us right into the next item. After the IRS goes through in the guidance and says, here's all the different things where we think we are going, what's under consideration, they say, we'd really like a comment on this specific issue. They say, we'd like to know, can a plan, and I'll dovetail this back to the multiple employer plans in a moment, can a plan basically say, we're only going to allow catch-ups because catch-ups are supposed to be universally available. Although there's a discussion and there's all these theory arguments, we made them about how it works in a governmental plan or not, but we can put that aside. The conservative view is that catch-up contributions need to be available on a universal basis and to everybody in the plan. And the IRS says, well, if an employer doesn't want to add Roth to their plan, can we just basically say it's only people who can do pre-tax catch-ups can do catch-ups only? And the IRS says, we'd like to hear what you think. They don't tip their hand and say, this is what we expect. But I think this dovetails directly into the multiple employer plan item. Because if in the multiple employer plan, they're treating each employer as its own almost separate plan and silo, assuming that they would get comfortable by saying, yes, you can just say that Roth catch-ups aren't available, so therefore over 145,000, you're not in for catch-ups, it would imply that you could then just do it employer by employer. That's one of the things I'm sure we will comment on in this process. But this gets to a lot of the discussions and the infamous question of, can you just have Roth for catch-ups? That's not even addressed here, but that's something that I think will come up. There's different schools of thought and different perspectives, but I think that dovetails into that. Sorry, Matt, I sort of took us to the next section, but I think your question teed right into it.
No, that was the hope. And I did think that part was very interesting. So this was section 6 of the guidance that came out. It kind of talked, which you would think would have pretty big implications in the government space. A lot of folks don't make over $145,000. Maybe some plans don't have anybody who's making over $145,000. Could you continue to offer catch-ups if you don't have Roth, assuming that nobody's above that line? And if somebody is above that line, you just don't offer it to them, which could have some implications. I don't know if an administrator would necessarily want to do that to prevent those folks who might be more likely to use catch-up contributions from doing it just because they don't want to implement Roth, but it would at least give that option, right?
Absolutely. There's lots of creative things you could consider because of the unique world of governmental plans. Could you have a plan that just says only people who are up to 145,000 in comp can be in this plan? And here's a separate plan over here. There's a million different ways to do it. But I think the IRS, again, back to their credit, rather than taking us on a road trip towards complexity and consternation, instead, I think is trying to come up with something that's very practical, which is good. And hopefully this continues and as we engage with them on comments.
Brigham, anything you want to add on that?
No, part? I think it's I agree with all of that. I think it does it doesn't answer all the questions on what if you don't have a Roth feature, what are your options, but I think it paves the way for comments, and I think they're going to get a lot of comments, and hopefully if they keep going in the practical manner they did in this guidance, hopefully we'll end up in a place where there is a good option or options that doesn't force plans that don't want to have Roth to add Roth. Yeah, great point. And that's something that I really want to emphasize for all of you as our members, that this I think is a really great first step. Hopefully it gives everybody a little bit of time. That was the goal. But now again, there's hard work and there's a lot of ambiguity, and we recognize that. So many of you have been sending in your questions to me and to to the NAGDCA website to say, hey, well, what about this? I would encourage you to keep doing that, because we're going to be in the process of writing our comments. They asked for them specifically. There are some, while there are some very specific sections of this law that they addressed, there are also broader sections that aren't addressed here that we would want to comment on as government plans as well. And whatever affects your plan, now's the time. So if you're looking at this and going, well, hey, nobody's talked about this, this portion of this law, now's the time to get clarification on that. Not only for section 603, I know we've spent a ton of time talking about this one, really very small section of Secure 2.0, but for the broader law in general, there's an opportunity here to get some guidance. And it seems like the IRS, as you mentioned, really is trying to help out. It could have gone a very different way. We thought this webinar was going to be a lot different than it was, where we were talking people through having to shut down catch-up contributions and those kind of things. It appears we were able to avoid that, and now we can make sure that we're all on the same page going forward. So
We did have a couple of other questions, just really quickly about would an administrative transfer of catch-up contributions from pre-tax to Roth be legally considered an in-plan Roth rollover? I don't believe that'd be the case, but David or Brigitte, either of you want to address that one?
Brigham, do you want it? I'm happy.
Yeah,
to
I'm not
answer
sure
it.
I'm following the seeing or following the question.
Yeah, I think, and I apologize if I misunderstand the question. I think I get it. It's where if effectively someone has made an election to do pre-tax catch-ups, and we say, sorry, the law now says we have to do them Roth in 2026. Is that considered to be an in-plan Roth rollover? And the answer in my mind is no at this point. The reason why I say that is because all we're doing is changing the election before the money hits the plan. Admittedly, I think all of us were thinking, who are presenting here, were thinking they might require us to do in-plan rollover conversions of Roth dollars as part of the transition relief, and we were happy they didn't. But I don't think that's part of the radar, part of the process and on the radar at this moment, and that's a positive.
Yeah. And then we had one more question just about whether contributions over the line, if you were above the maximum, would be forced into Roth, and that is correct. So if you're over the 145 limit, once this goes into effect, once you put the program in effect, those contributions are forced into Roth. Also had a question, and I do want to clarify this for those of you who may not have been following some of the other sessions that we had. We're just talking about the 50 plus catch up here. We're not this does not apply to the special catch up provisions either for 457 plans or 403B plans. Those are not affected by this. So we're just talking 50 plus catch up for government plans. So want to be really clear on that as well. So I don't see any other questions coming through. David, Brigham, any kind of final thoughts you want to put out there before we wrap up today? Again, a little shorter because it actually the guidance was actually helpful, which I think is pretty great.
No, I think just keep your questions or comments coming, because we will be doing a detailed comment letter in response and on the next step. So yeah, let us know your thoughts, particularly on some of the issues that Matt and David flagged today.
I concur with Brigham.
All right. Well, we're not going to keep you any longer than we need to. Hopefully, this makes everybody's life a little lighter going into the rest of the year, and gives you a little more time to process this. Much more to follow on all this, and very much appreciate all of you for showing up. Yeah, go ahead.
Hey, Matt, I think we have one question that's actually in the Q&A that's separate at this point.
Okay.
And I'm a little I'm a little confused. Sorry, who the person who submitted, I'm not going to call them out by name.
Sure.
You might clarify. The question that's sitting there in the Q&A is, what if someone contributes to their designated Roth by as much or more than the catch-up amount, and then decides to put the final contributions into the 401k? Will they be forced to put those last dollars into the designated Roth as well if they are over the income limit? I'm not exactly sure where that last question is coming from, whether it's talking about a 401k and a 457 situation. But I think in general, if it's more of a macro, I have a plan that has pre-tax, which I think might be what 401k means here. And I apologize if I misunderstand the question. And I also have Roth in there. And if they put in and they put in to the Roth for the year, and then say I want to finish out doing pre-tax dollars, once money's already in, are they going to, and they're into catch up already, are they going to have to do them as Roth? I would argue probably yes. This gets to a very interesting discussion about, can people recharacterize, and we have this in IRAs about Roth IRAs and traditional IRAs all the time. But I think that if you're in catch-ups and you're subject to the Roth requirement and you hit the catch-up level, even though you could have done pre-tax before you hit it, I think the conservative view probably right now is you're going to have to do it as Roth catch-up. Can you mess around, sort of, and say recharacterize things? maybe that'll be a whole new administrative complexity, but I don't even think that the IRS has given any thought to that as far as I know yet. Hopefully that answers the question being raised. Thank you for your
Yeah.
clarification.
Yeah, if it doesn't, just feel free to send me an email and we can get you, we'll get you a clearer answer. And that goes for everybody. If there's something that comes up, in the next couple of days or something that's on your mind, please feel free to send me a note and we'll get your questions answered. We're also going to update, we have the Q&A doc on the website. We're going to update that to reflect this guidance because obviously some of especially the aspects of Section 603 changed because of the new guidance that was put out. So much more to follow, like I said, but we really appreciate all of your help for all of you, those of you who were able to speak up and join our calls and able to send a letter in. Those were very effective. And you can see that the process in this case worked. We got some extra time and hopefully it allows all of you to get your program set up the right way. All right. So that's it from us. Thank you all very much. And David and Brigham, thanks a lot for joining us today.
Thank you.
Thank you.
All right, have a good one, everybody.
Thank you so much.